Good morning. I'm sorry to interrupt your networking, but now you guys have to stay and watch this thing that I made. My name is Justin Norman. I started a media business and a production company about 6 years ago called The Flip. We produce stories that tell stories of progress from emerging markets. We're working on a stablecoin documentary series where I think hopefully everybody in this room will agree that the emerging market use cases are quite exciting for stablecoins, but my own experience living and working across Africa for 10 years has taught me that the conditions on the ground are not very well understood. Certainly in the US context, I'm sure there's a lot of people who are asking, why do we need stablecoins if we have SWIFT and banking rails and other things like that? And my aim for this series is to show the realities on the ground that are driving stablecoin adoption. And I certainly think and am going to argue that the conditions in emerging markets are ripe for stablecoin adoption, even more ripe than certainly in the US. So every episode of this series is going to be filmed on the ground across emerging markets in a different market and showing the use cases that are driving adoption. This first episode, though, is a bit of a top-down story around stablecoin adoption, filmed with Zach Abrams, the CEO of Bridge. And he's a great case study, not only because of the success Bridge has had in selling to Stripe, but because of the story that he tells of the fact that he started this stablecoin business not really knowing the use cases, and then he found out along the way, despite having worked in the US all his career, that all of their product market fit is coming from outside of the US. So we're going to hit play on a short 9-minute film. I hope you guys enjoy it, and then we'll do a little bit of a discussion afterwards, and if anyone has any questions or wants to have a discussion, we can do that. So please enjoy. So people in the US ask you, why do you need stablecoins?
All the time.
Millions of people around the world are using stablecoins.
Are the banks about to break?
But it's not why you might think.
Democratize access to dollars. Everybody wants dollars.
It's not who you might think.
Mom and pop shops, suppliers in emerging markets.
And it's not where you might think.
We want everybody to have access to financial services, irrespective of who you are and where you are. And that's what stablecoin do for us.
A stablecoin.
A new frontier has been opened for the use of stablecoins.
Stablecoins are finally happening.
Stablecoins have seen an explosion of growth.
In 2024, over $26 trillion was transferred in stablecoins.
You've probably seen technological explanations of stablecoins.
These are cryptocurrencies that are pegged one-to-one with the US dollar.
But that only tells part of the story. What I want to know is, who's using stablecoins and why? What is it about their day-to-day realities in the places they live that lead to stablecoin adoption?
We discussed our plans for the stabilization of world currency.
Stability and equal treatment is in everybody's best interest.
If you can move money faster, or move money more cheaply, or save people money in some capacity, then
You're here.
that financial service ends up winning. Our belief was that stablecoins made a lot of those things possible.
That's Zach Abrams, the co-founder and CEO of Bridge. Bridge builds the backbone for stablecoin adoption. Its software lets companies seamlessly move money and make payments using stablecoins.
Stripe just announced in the last week
a $1.1 billion deal to buy Bridge.
The company exploded onto the scene when the global fintech Stripe acquired it for $1.1 billion, despite being just 2 years old. Remember when Google bought YouTube or when Facebook snapped up Instagram? Their growth exploded, and both startups had a profound impact on their new parent companies. This feels like one of those moments. And if stablecoins are truly the next big thing, then this is the guy we need to talk to first.
When the Stripe acquisition was announced, we very viscerally felt Bridge and stablecoins shift where we were along the adoption curve. Before Stripe, there was a lot of entrepreneurs all around the world who wanted to build on top of stablecoins. After the acquisition, there was all these global business started coming because they wanted to build something with stablecoins.
Stablecoins are digital currencies with a value tied to an underlying asset. The most popular stablecoins are dollar-backed stablecoins, like USDC or USDT. So one coin equals $1. But these currencies are built on the blockchain, so they get all of the technological benefits of crypto without the volatility. They're cheaper and faster to settle than fiat currencies, and stablecoins are default global. which means anyone in the world can access them, bypassing banking infrastructure limitations, especially in underbanked regions. Stablecoin transaction volumes have doubled over the past 12 months, where total volumes have grown to over $33 trillion.
Put into perspective, is more than Visa and MasterCard put together.
And combined, the top dollar-denominated stablecoins are the 17th largest holder of U.S. Treasuries globally. Stablecoins have become increasingly popular for non-crypto use cases.
We started the company in the US. All of our experience has been building financial services in the US, but today, almost the entirety of our product market fit is outside the US. It sounds weird now, but we really had no idea about literally any of the use cases that we're supporting today. It was very much a if you built it, they will come type hypothesis. We deeply believed in this thesis that if you could move money faster, cheaper, if you could enable people to build fintechs much more quickly, that folks would come and be rational about the building blocks that they used. But we were not sure what use cases were going to be right. We launched our APIs 2 years ago, and more or less every 2-3 months, some new use case has emerged that's seemingly bigger than all of those before it. The first use case that we saw was cross-border payments. The second use case was global payouts. So Scale.ai or the US government dispersing payments to people in a lot of different countries. Then we saw a lot of what we call dollar access customers. So a neobank building for the Latin American market or the African market, building on top of stablecoins.
I just got paid for my first international gig.
Then we saw treasury management. This was SpaceX selling Starlink all over the world and repatriating those funds to the US via stablecoins. And we just launched a global card product, which will enable a whole new class of fintechs to globally issue cards for consumers and businesses. And we fully expect that in the next 3 months, some other use case will come along that dwarfs all these.
While a stablecoin can be a virtual representation of any asset, the reason why dollar-backed stablecoins are the most popular is because of what the dollar is used for in the global economy. Approximately 2/3 of all US dollars, or $1.58 trillion, circulate outside the United States. The US dollar is 59% of reserve currencies, but besides holding dollars for savings and investment, much of the demand is for the utility of the dollar. 64% of world debt is denominated in dollars, 54% of foreign trade invoices globally are in dollars, and even if you're invoiced in a different currency, you probably still need to go through dollars, as 88% of all foreign exchange transactions globally involve the US dollar. And demand will continue to grow from emerging markets in particular, where the share in global trade has tripled in the last 35 years. But dollars can be hard to come by in emerging markets where there are import deficits and currency devaluation. So the early adopters are turning to stablecoins.
We are in Computer Village.
In Lagos, Nigeria's Computer Village, these cell phone parts are all imported from China. They pay their suppliers using stablecoins.
When you think about Africa, for example, you have 44 million SMEs. 61% of them are doing cross-border trade because a lot of these countries are constantly importing goods. I think what people don't sometimes realize is even an informal trader needs to buy something from China or from another country. And because of that, they all need dollars. And these informal traders are more likely to use stablecoins because they want to leapfrog. They want to get services they can't get from a bank. And so there's a huge opportunity to use stablecoins.
In Manila, Philippines, these virtual assistants are working the night shift for a US-based company. They're paid in dollars using stablecoins. In Mexico City, these people instantly receive money from their relatives, which they use for local spending. And in Sao Paulo, in Buenos Aires, in Nairobi, in Jakarta, and all around emerging markets, where these same problems exist for everyday people. In 2021, Stripe launched Payment Links, a use case that took off in emerging markets. At the time of its launch, Stripe's co-founder and CEO, Patrick Collison, wrote, quote, "I suspect that staying abreast of important new patterns emerging outside of the US and Europe will become more important for many businesses in the years ahead. There are a lot of legacy assumptions being questioned." This is the story of stablecoin adoption. People in emerging markets are using stablecoins for real use cases, where the global banking system doesn't work for the majority of the population's everyday needs. It's not just that stablecoins are faster or cheaper, but that their accessibility and technological properties could enable new use cases not yet imagined. And this is why, if we want stablecoins to reach their full potential, we need to understand why they're being used in the rest of the world.
I think people in the US think the whole world is the US. You know, if a US fintech doesn't need stablecoins to serve a US consumer, then what's the point? But there's billions of people outside the US, the majority of which are significantly more underserved than the people in the US. The US market is really big, so most companies can become very successful just serving that market. But, you know, the rest of the world is a whole lot bigger.
This episode is the first of the Flip's new series on stablecoin adoption. In this series, we're going to journey through emerging markets to tell the human stories behind the on-chain data, bringing to life the conditions at the last mile that are driving stablecoin adoption. So be sure to hit that subscribe button as we explore how money moves.
Excellent. Well, thank you all for coming. And it's really on point to start with storytelling. I think there's so much narrative today around stablecoins and the potential to re-platform, transform, disrupt, and a lot of the discourse is focused on Western use cases, when really the majority, if not a lot of, you know, the really critical use cases and adoption is not in the West. It's in emerging markets. And stories like what Justin and the Flip are telling need to be told and need to be broadly understood for the builders in the space to really understand what problems are being solved. How did you get started, like thinking through how you would start telling these types of stories?
Yeah, I mean, I think I went on a journey that I would imagine that a lot of people building in the stablecoin space went on as well, where I was born and raised in the US, I moved to South Africa, I lived and worked across the continent for a decade. I remember vividly the first time I sent a remittance payment in 2017 to pay my rent in South Africa and thinking like, I can't believe this takes so long, it's so expensive, right? You know, like crypto and Bitcoin is already a thing. And then as I would travel around, you know, I intellectually understood the problems and the pain points in emerging markets, but then it's another thing to be in Nigeria and to not have your cards work and to need to exchange your crisp $100 bills at the Echo Atlantic Hotel gift shop in the parking lot and get 1,000 Naira notes. And so, you know, we felt increasingly like as we see this stablecoin wave pick up and the narratives that are being told about it, you know, I think that, you know, and certainly in our experience, what we believe to be the most exciting thing about stablecoins are not being talked about enough or being overshadowed by narratives that are not really representative of what we believe is the biggest opportunity. And so I think that, you know, I don't want to kind of invoke crypto. I don't really think that this is like a crypto story, but, you know, there was always the trope that crypto was searching for a use case, right? And now the worry is that people building in stablecoins are going to search for a use case in the US context, whereas we already know that there's big problems to solve with stablecoins in emerging markets. And that's why I wanted to do this first episode with Zach in particular, is because he's telling a story of, we didn't really know what we were solving for. We had this hypothesis. All of our experience was in the US, and it turns out that all of our customers come from outside of the US and are solving a problem that we didn't know about when we started the business, right? So if a guy who, you know, sold his business for $1 billion can say that, I think we should listen to what he has to say about that.
Yeah, absolutely. And it's really great that he does say that, and he's very humble about it. And you can see those words written on a page, and you can hear him say those things, and it doesn't necessarily hit viscerally what that really means. And oftentimes, you know, humans, we get these concepts through stories, through anecdotes, through a friend who tells you about their trip, and not everyone is going to be able to go to Lagos and understand what it means to use this digital bank transfers for everything, or M-Pesa, or all these other, you go to Argentina, you in Buenos Aires, and everyone knows two numbers. You know the blue rate and then the regular rate. And it's just a way of life. And it's hard to understand that without portrayal of the individuals beneath those stories.
I mean, I think that everyone should get on a plane and go to these places, but like knowing that not everyone is going to, I think the next best thing is how can we bring to life these stories, right? And so that's what this series is going to be about. We're going to publish one episode a month for the next 10 months or the foreseeable future, and go to the places where people are doing it and talk to the users at the last mile and understand their everyday pain points, right? And they're not well understood. You know, I mean, we can talk about Nigeria again. The Nigerian context is not, you know, if you're a small trader. You heard Barbara had an amazing stat that, you know, there's 40 million informal SMEs on the continent, and 61% are importing because Nigeria doesn't manufacture anything. There's a massive import deficit, but they're not served by their banks, right? It's not like you can just go and get trade financing or source FX, and so you know, that's what pushes informality. And it's not that stablecoins are even disrupting the local banks. Stablecoins are disrupting like informal hawala, right? So like a trader needing to find a way to pay their invoice in China via WeChat, right? And that's not well understood, right? And so how can we go there, bring those stories to life, and then tell them to folks who are building in this space? That's really the objective.
Yeah. And how are you thinking about choosing which stories to tell and which locations to capture?
Well, I've been talking to a lot of people, right? So, you know, I think especially for me, you know, not living in all of these places, you know, the use cases and the stories need to be informed by the people who are building on the ground, right? So we've been having conversations with founders in Brazil and Colombia and Mexico and India, Indonesia, Nigeria, South Africa, Kenya, to get an understanding of that local context and where the use cases are most interesting. And what I think is also important to recognize, like often we paint very broad brush, but like the B2B trade story in Nigeria is different from the use cases driving adoption for B2B traders in Brazil, for example, right? And so, again, while we're planning to do an initial 10 episodes, as we peel back more layers of the onion, there's 1,000 that we could do, right? Or maybe not 1,000, but you know, a lot more that we could do, because I think that, you know, it's important to understand the local context in all of these markets.
Yeah, and you know, I know you didn't mention it offhand, but you could easily get to 1,000 stories portrayed in different ways, but each location has its own kind of geopolitical, cultural like underpinnings that determine how money is actually used in those places. And then within that particular region, you then have the use cases of dollar access, cross-border payments, even merchant acceptance, and each of those can have an individual behind it has a relative abroad, or who's trying to save up for school, or is trying to like do trading on the side. So there's all these different complexities that can be captured.
Yeah, regulation in every market, even within markets, right? So we know in Mexico, for example, the use cases in the north of Mexico versus like Mexico City are very different too, right? Or different countries that have a sort of a big income divide, how it's being used across different sort of socioeconomic groupings. So yeah, this is the first of many episodes, but we've planned the first 10 at least.
Mm-hmm. And so when you think about the watchers, the audience of this, what would you say is like the key thing you'd like them to take away, and what actions would you want them to be taking afterwards?
That's a good question. I mean, I think I want them to challenge their priors, especially if they're based in the US and haven't spent as much time on the ground in these markets. You know, ideally, I want them to, you know, watch and share these with their entire teams and other people. But I think an amazing action would also be like they get on a plane, right? If they're doing something cross-border related and they see that use cases are coming from some of these markets, you know, they should go and find the founders who are building there locally, go get on a plane. Right. Yeah, I mean, I feel very strongly about understanding that local context, and I think that we can play a role in that, but you know, having that last mile connection point and experience, I think, is very important too.
Right. Yeah, and I can almost see a way that Western companies, at least the ones that, including the ones that have kind of cross-border or like global like businesses and trade, start to like rethink their roadmaps, and you know, maybe like taking like a leaf out of the book and sending teams and spending more time on the ground versus a lot of the kind of like desktop research that tends to drive a lot of these.
And that's a really interesting point. Like our experience on the African continent often is that the rest of the world doesn't really care because it's too risky of a place, or it's not worth it from a revenue perspective, right? And I think stablecoins are a really interesting one where we wanted to show the way in which dollars are used outside of the continent, outside of the U.S. I should say, and I think that there's a really big potential to build even bigger businesses outside of the country, right? And that requires you to kind of change the paradigm with which you would normally build a business. And it may actually be that everywhere outside of the U.S. is actually a more lucrative place to focus on if you want to build something in stablecoins than inside. And that's a different paradigm than what we're used to seeing when we're talking about kind of traditional fintechs or other businesses.
Right.
Yeah.
And does that mean that, I guess, over time, once you feel a sufficient story has been told of emerging markets, you may actually come back to see use cases in developed markets?
I don't know. I mean, I think that everyone here has an expectation that U.S. market adoption is going to increase once there's like stablecoin regulation, and I think that that's probably true. But I do also think that we'll come to realize that the domestic use case for stablecoins is never really going to be that interesting, right? Or it would need to disrupt some really entrenched network effects. Whereas U.S. companies that are the most interested in stablecoins are the ones who are doing stuff cross-border anyway, right? And so I guess that's a developed market story, but it's still a story that is cross-border, right?
Yeah, and the way I look at this is there are concentric circles of adoption, and at the center of it are these existing use cases that tend to be emerging market driven or cross-border, where the pull to solve the problem was so great that users and consumers and businesses looked past UX issues and are using it today by jumping through multiple hoops. And then over time, as more infrastructure is built and more adoption, then later use cases, payouts, merchant acceptance, and others that tend to be more towards the kind of developed market use case, particularly in the US with like replacing card payments, start to come online. But that is its own wave. And really, it's all about timing. And for now, in terms of looking at a lot of the existing volume of the current kind of cross-border use cases, it's emerging markets. And understanding that is kind of key to driving adoption today, but also learning lessons and understanding like pain points to drive some of the later concentric circles.
And I think that timing question is interesting. I'm sure there's a lot of people that are ready for it to be time to do stuff in the US, but our experience, right, tells us that there's still a lot of problems to solve in the places where the stablecoin adoption is the most meaningful because of, again, the market dynamics and that we talked about, right? So I think while it might be tempting to get to that next phase, there's still a lot of room for growth in these markets that, as Zach said at the end, in aggregate are bigger than just the U.S. use case. So.
Yeah, absolutely. And one of the things we wanted to do is make this interactive. There's the documentary itself, there's the video, but then there's the goal of what we're trying to achieve with the storytelling. And I would really love to invite the audience here to raise their hands and ask questions as to the topic at hand and where else one can take it. I see we've got one here.
And what I also want to know is, for those who are building, if there's questions that you commonly get asked or misconceptions that you have or things that you feel like need to be cleared up. I think we, in developing narratives, want to get feedback from people too. So that's my prompt. But
great. Good to see you both. Very quick question with regards to economic autonomy for emerging markets, Africa to be specific, because that's a place where we play in. The issue with stablecoins is that once it becomes adopted at a mass scale, it creates an element where there's no visibility in terms of trade if these things catch on, as you mentioned, in West Africa, right? So regulators are going to want to find out, like, why are we missing a basis point on GDP now, quarter by quarter? And this is very important for them because that's the metric, and that's how they manage growth, right? So do you see maybe something that needs to be more visible with respect to stablecoins? And I know innovation, always leads and then regulation follows. But where do you see regulators needing that oversight? Because for now, 1% of the money supplied is stablecoins. If that reaches 50% and it's not visible to governments that need to give that information back to the World Bank, it becomes awkward.
Yeah, no, I think this is a really interesting question, and there's like a couple of elements. Governments, local governments, particularly in Africa, and in particular ones that have capital controls and FX controls, it's a problem. And one wants to maintain their currency sovereignty and also the regulations that they already have in place. And so thinking about, there's a couple of things that will need to occur, but what I'll start with is relative to the alternative, which is black market, zero visibility, there are the underlying ingredients of more visibility. And it requires a concerted effort, but through clever and kind of coordinated legislation and licensing, which is what we're seeing increasingly in Nigeria, there can be a framework for reporting. And that will not capture everything. The black market will always exist. But unlike pre-blockchain black market transactions, things are on the blockchain forever. And so over time, even though authorities may not necessarily have the skills to do the forensic work, eventually they will catch up and be able to, in hindsight, enforce some of the rules that are necessary. But in general, I think the transparency of the blockchain, at least where we are today, is actually a feather in the cap of the sovereigns in order to say, okay, this is beneficial, this is more efficient, but there are reasons that we need these controls. Therefore, if you're doing a foreign currency conversion, which is not currently how these things are categorized, but if you categorize them as foreign currency conversions, you need licensing. And if you're caught without doing this transaction without licensing, here are the repercussions. Over time, things will shift, but as I mentioned, you're never going to avoid the black market.
What about local stablecoins, like non-USD stablecoins?
I think that's a really interesting topic of discussion, and there will be adoption, but adoption is always relative. And the interesting thing that I find about stablecoins today and US dollar stablecoins is that there's the underlying technology, which is putting fiat on chain and enabling the blockchain benefits of instant settlement, decentralization, and kind of global accessibility. And then there's the underlying, the dollar. And the dollar is the product today, hence 99.x% of stablecoin volume TAM is dollars. And when you put other currencies on chain, yes, you have those settlement benefits, but the dollar is not the thing that people are accessing. And so therefore the use cases for non-US dollar stablecoins are only specifically things that need the settlement and accessibility benefits. The other angle is if you as a sovereign, as a central bank, wanting to set very strong controls over how money is used locally, then it can start to shift into like the CBDC or like local payment rail approach, in which case it's just another technology rather than being another global asset. And the last thing that I'll say is I'm really excited to see where non-US dollar stablecoin use cases will show up. There's a lot of excitement around on-chain FX, but it's not just technology when solving FX problems, right? It's capital and coordination. And there are lots of folks, smart folks, trying to solve that problem, but it really is an incentive alignment problem as well. And then another use case that we see is the classic regulatory arbitrage, where today you often need licensing in order to serve customers in a particular country. And the way that regulation is written today is fiat is defined in this way. And therefore, if you want to hold fiat on behalf of customers, you need these licensing. And then local currency stablecoins aren't quite captured, and therefore you can enter a market and serve customers of that market with a local currency stablecoin and capture share in this narrow window or maybe it's not narrow, but this window that we have where the regulation hasn't caught up. And so I see that there are use cases. How long they will remain open for is TBD. And in general, I think it's still going to be like a small fraction of the US dollar use case, as long as the US remains the global reserve currency.
Hello, I have many questions. Can you talk a little bit about, so you mentioned conditions on the ground and like being able to observe like what's actually happening in all these different countries. Can you talk a little bit about like what is like the consumer endpoint? Like how are people getting the stable coins, right? Like is it in a wallet app like Wave? Is it like through their bank account? Like how is it actually being stored? Are they spending in stables? Do they off ramp into like local, like when do they off ramp it? Or are they able to like, is there like a merchant network being built up? Can you talk just a little bit about what the conditions on the ground for the consumers are?
Yeah. And I think it depends a little bit on like the user profile and what they're trying to do, but there's kind of like two main experiences. One is an exchange or peer-to-peer even, right? There's a lot of peer-to-peer on Binance for accessing as like an on-ramp, right? But the on-ramp might actually be peer-to-peer as opposed to using a local exchange, but local exchanges obviously as a big gateway for a lot of these folks. But then, I think what's starting to happen also, which is quite interesting, and we'll see how this evolves, is a lot of these markets have informal FX traders, right? So you go to a WeChat or a WhatsApp group or a Telegram group, and you're sourcing your dollars informally, right? These informal traders are starting to now just have USDC or USDT, because obviously then it makes it easier for it to be sent to a Chinese exporter, for example, in Hong Kong. Dollars, yeah. Or in some cases it would also be, you'd find a Nigerian national, for example, living in China who ends up as that endpoint to like pay the invoice for you in local currency, right? And then they've got a bank account in Nigeria. But there's still a lot of these informal middlemen that are just now using USDC or more often USDT to be that bridge between currencies for them. So it'll be interesting. I mean, it's like an informal stablecoin sandwich, right? So in many cases, the importer and the exporter aren't actually touching, right? And so I think it will be interesting to see as more B2B companies that are enabling cross-border flows come up, like how far down in the last mile of informality they go. I don't have an answer, but I suspect that most people, and where we probably want the market to get to, is most of the last mile users won't even necessarily know that the money is going through stablecoins anyway, right? I think that there's an early adopter crop of folks who are comfortable using it because they've got really big pain points and they view this as low risk. But whatever on the adoption curve, everyone else may not end up touching it, and it'll be just abstracted by people who are building the connection points accordingly.
Yeah, and one thing I'll say is meeting people where they are is super critical and is what is driving a lot of adoption. I think there's a company called Accrue. What they do is it's an agent network built or bootstrapped off the existing mobile money agent networks, where you have local folks where you can go and exchange cash for mobile credit, and it's those same people, instead of giving you mobile credit, they'll give you Tether instead. And folks use Binance Wallet, like custodial, not even like non-custody, Trust Wallet, and others, and another company, Phone Bank, where they connect a network of traders, OTC, where one person will send in mobile money and then receive stablecoin. And it'll all happen within like a minute or less than a minute. And so it's connecting what people already have, tends to be mobile money or cash, to getting on-ramped via like these applications or people in person, rather than going through, say, like an exchange or onboarded on-ramps that we do in the West.
That was partly my next question, but also what I wanted to ask was, we spoke a lot about using stables by SMEs to actually pay for their manufacturers. And I think a lot of the local networks are actually using M-Peso or other players that have built that network that are now gonna maybe act as on-ramps and off-ramps. But beyond just holding maybe a USD stablecoin as a store of value, are customers actually also transferring each other? Is there like domestic use cases for USDC or USD stablecoins for payments, or how we use it like Venmo in the US?
Domestic use cases in the US, or?
Domestic use cases in the US rather than paying vendors for USD stablecoins.
In the US or in emerging markets?
In the emerging markets.
Yeah. It's interesting. I think this is also a question of, in my view, like, are we experiencing dollarization, right? So Argentina, Turkey, like there's various degrees of dollarization, right? So they're holding dollars more as a hedge against devaluation and to protect their purchasing power. But then there's other markets with similar profiles of devaluation, like Nigeria, where for whatever reason you're not really seeing dollarization. And so I think, I don't know how interesting, I think it kind of remains to be seen. Like your sending question to me is also a spending question, right? So are people holding dollar-backed stablecoins just to save, or with the intent to also spend, right? It also depends on how they're earning, right? So if they're living in one of these markets and they're earning in dollars, is their intention to off-ramp to spend locally, or increasingly will merchants accept stablecoins, or would it be, Visa puts a card on the end of it and converts it into local currency?
But in a lot of these emerging markets, are merchants actually accepting cards? Because card network is also pretty bad.
Yeah, I think that's a good point also. It depends on what kind of corner of the market we're talking about too. I think it's an interesting question around those who are earning dollars in one of these markets. Are they spending in a place where there is card acceptance, right? And if they're not earning dollars, and if it's local, like, they're in the cash-based economy, which is kind of one step further in the last mile anyway.
I mean, if one of the episodes could be about that, it would be amazing.
Yeah, that's a good idea.
Yeah, and I'll just add, yes. Yes, people, it's what you have versus what you'll send is a kind of function of like, what do you accept? I'm already holding a form of currency that you accept. That's the kind of P2P element. And there's lots of informal trade. You go to the hairdresser, you go to pay a rent, and the other person on the other side is a person, but they're also like SME or micro SME or running a business. And we both have local currency and we both have dollars. And then that's the question of, okay, I'd rather accept. Yes, but whoever has the most negotiation leverage can kind of set the terms. But I think that in a really interesting example is like in Dubai. You're going, and there's lots of international people there. You can move dirhams around, but a lot of people are expats. And so the kind of common denominator is dollars. And so they'll say, okay, well, you have dollars, great, then send me Tether and I'll accept it. And so that's really merchant acceptance, but in a P2P way, because it's an informal thing like a haircut or something like that.
Last question.
Hey guys, from your experience on the ground, the rail that is mostly used to on-ramp to stables for SMEs, is that rather cash to stable or using local banking rails to stable into a wallet?
Both. I think it also depends what market we're talking about, and again, like what sort of demographic of the market, but especially where we're talking about markets where the on-ramp into digital currencies, and I'm not saying crypto, but like mobile money, for example, is agents and cash. Like I think it's reasonable to expect that on-ramps into crypto is going to be similar, or on-ramps into stablecoins. And that's where, you know, Chuck said meeting people where they are. I mean, I think it is quite interesting, you know, where there are markets that allow for like agent networks to be an on-ramp. Like you're going to see more of that just because that infrastructure exists and can be utilized. But then in obviously, you know, a bit more formal markets, I think the exchanges are connected to the banking rails in more traditional ways as well. It depends on the market. Anything you want to add or no?
Yeah, it depends on the market, and I think it's where the infrastructure has been built. It can be cash, and I guess another thing is on-ramps don't necessarily happen one-to-one with I have this and I'm turning it into this other thing. It's, hey, I'm making a sale and I'm going to receive in stable and I'm going to keep it in stable. So that there's multiple ways to on-ramp, and they're not all necessarily from starting with an asset that you have.
And I should also say, like, peer-to-peer is also a big on-ramp, right? So I don't think we think of it in that traditional way, but it's I'll give you cash, you send me. And that happens quite a lot in these markets also. Cool. Thank you very much.